Rick, I'd like to start this discussion with the commodity that I think both you and I have received the maximum number of queries on over the last 3 weeks, and that is uranium. There were a lot of questions that were sent in on the recent breakout in uranium equities, so I'd like to ask you 3 questions here. Let me start with some numbers. Global nuclear energy consumption today is 24.9 exajoules. In 2011, the number was 24.7 exajoules. So the demand for nuclear energy is almost where it was back in 2011. In fact, it exceeds that by a small amount. Uranium spot prices do not reflect this and are below what they should be if there were any reflection of production economics. Over the last little while, we've seen suspension of mines by Cameco, Orano, and Kazatomprom, but the spot price is still $30 a pound. So the question for you is this still a case that there's uncommitted supply filling the gap? And from your perspective, what do you think is required for a sustained uptrend in spot price?
I think it's important to note, first of all, that while the spot price is interesting, it may account for 15 or 20% of uranium transactions. Most uranium transactions take place in very opaque long-term contracts. And so you need to understand that the spot market doesn't necessarily reflect the uranium market as a whole. As you have pointed out, worldwide demand for uranium now exceeds worldwide demand for uranium before that demand was crushed by Fukushima and its aftermath and the shutting down, as an example, of the Japanese nuclear fleet and, to a lesser extent, the German nuclear fleet. What's interesting to note from the uranium bull's perspective is that growth in demand worldwide, particularly from Korea and China, has now allowed the industry to use more uranium than it did before that disaster. And any resumption of uranium consumption by Japan, which I've always believed was the linchpin consumer, is in effect icing on the cake. It's also worth noting that in 2011, it's arguable that the price that we enjoyed was substantially above the price that was needed to maintain production, which is to say that the price fell from heights that were already too high. My own belief is that the uranium prices would have fallen, not as far, not as fast, even without Fukushima, as a consequence of the incredible increases in production that we saw in Kazakhstan. Now, it's important for uranium investors to note a couple things. First of all, there's a substantial deficit now in terms of simple supply and demand. That is, the uranium that we either produce or recycle is insufficient to fuel reactor demand. And the surplus is being met by above ground inventories, which were swollen substantially in the 2006 to 2011 timeframe. What's important to note there, however, is the relationship between the production deficit, which is believed to be between 30 and 40 million pounds a year, and the inventories, which are widely believed to exceed, if only slightly, 1 billion pounds. What's important to note about the inventories is not the aggregate or gross level of inventories, but rather the inventory available for sale. And the inventory available for sale, that is, inventory that is uncommitted by existing nuclear power plants, and importantly by the credit facilities associated with those power plants, is believed to be between 100 and 120 million pounds, although that number is very opaque. When you look at above ground supplies of uranium at 1 billion pounds and you juxtapose that to a deficit of 30 to 40 million pounds, it looks like the world is supplied with uranium for all time. If, however, you look at the inventory available for sale relative to the deficit, then all of a sudden you understand the coming tightness that everybody sees in the uranium business.
A lot of the ups and downs that we've seen in the uranium market over the last 18 months have really been related to policy matters in the U.S. It started with Section 232, then it moved on to the Nuclear Fuel Working Group, then we had the Russian Suspension Agreement, and now most recently there's been a uranium reserve bill that was approved by the Senate committee. The U.S. market consumes over 50 million pounds of uranium a year, so it's big in terms of size and influence. Do you see the policy drivers, all these policy decisions that we've been seeing in the U.S. market as a significant driver for the uranium bull market and for uranium spot prices in any way?
I do not. I think that the world market in uranium is liquid enough, and that America's supply considerations are much more largely political than practical. The truth is that I suspect that we can rely for a very long time on our friends north of the border, the Canadians, to produce all of the uranium and sell all the uranium to us that we need. That said, the idea that you would subsidize U.S. producers, well, from my point of view, is stupid politically, will do something, I think, to buoy the operating performance and certainly the share market performance of those few companies that are capable of producing U.S. uranium. The truth is, in the very near term, I think there are three things that you need to consider with regards to uranium. The first is general world economic growth. The second is the health of the Chinese export economy, because that's where the growth in uranium consumption is coming from. And the third will be the pace of Japanese restarts. As Americans, we tend to be ethnocentric, and certainly we are the world's largest consumer of uranium. But my suspicion is at market clearing prices that the Canadians would be a wonderful source. Remember that our primary source of uranium, that is import uranium in the decade 2000 to 2010, actually came from the Russians. A wonderful program where both countries began to dismantle their inventories of weapons-grade uranium, turning it into fuel-grade uranium, probably to the betterment of mankind. So while I understand the question, Aditya, I think that you need to look at the uranium market in a very global context.
One of the hardest parts about being a contrarian investor is not being completely wrong in timing. The wind is in gold sales today because of a lot of chaos that we see in the world. Do you see those factors being winds for energy demand over the next 2 or 3 years, which could potentially delay a recovery in both uranium and oil and gas over that time frame?
I do not with regards to uranium or oil and gas. In fact, both of them are essential commodities to the way that we live our lives. Neither of them require any particular demand growth because the supply constraints are already cooked into the equation as a consequence of the decline in sustaining capital investments. In the case of both uranium and oil and gas, supply shortages in the 2 to 3 year time frame are almost guaranteed by constraints sustaining capital and new project investment capital. Whether or not we see meteoric price rises in the next 2 to 3 year time frame is a different set of circumstances. But the same tailwinds, or rather the same sort of dimension with regards to tailwind that was put in place in the gold market in 2015, 2016, and 2017, which began to propel the gold bull market that we're enjoying today, exists in both uranium and oil and gas. Ironically, investors seem to need pricing signals to justify the narrative, which is to say, now that the gold price is cleaned up from $1,100 an ounce to $1,850 an ounce, in other words, now that the first part of the precious metals move is over, investors are attracted to it. Similarly, although the wind is already in the sales of oil and gas and already in the sales of uranium, this wind hasn't been reflected in the commodity price. So although they have to go up, investors don't care because they haven't seen the pricing signal yet. The point of being a contrarian, as Buffett so wisely says, is to buy straw hats in winter. And this is certainly, horrible pun, a nuclear winter. it would be easy for my uranium thesis to be wrong for another 12 to 18 months. Easy. The truth was, in the last uranium bull market, I was, by my count, 4 years early, perhaps 5 years early. It took a lot of fortitude on my own part to endure, first of all, being early, and second of all, to deal with the volatility in the market. Given the gains that I enjoyed afterwards, that patience was well rewarded, and I suspect that will be the case this time for investors who are both psychologically and financially prepared. If investors require the confidence of price signals over a long weekend, uranium is the wrong place to be. Sustained price move could begin as early as the first quarter 2021, or it could be 2022 or 2023. I don't really know. What I do know is that uranium is such an important part of world baseload energy consumption that if the price doesn't return to the incentive price to produce uranium, the lights will go out. Those are the two choices. That is certainty enough for me.
With this in mind, what should a resource portfolio look like today in terms of having different commodities included within it? Everyone is different, and everyone has a different risk tolerance, time frame, and investment objective. But if you were to give a broad response to this question, given some of the things that we've just discussed, how would you recommend people think about tiering their resource portfolios?
Well, first of all, the resource portfolio needs to be considered in the context of someone's overall portfolio. Sometimes when people get attracted to the resource narrative, they get over-attracted to the resource narrative, which is to say that 100% of their investment portfolio is in resources, where they don't have a sufficient knowledge base to operate a resource portfolio that has taken on their whole net worth. I am not uncomfortable in resource bear markets, which I think we're coming out of, seeing investment portfolios that are 20 to 35% invested in natural resources. I don't like to see it much above 35% in natural resources. And if you are going to have a portfolio that is concentrated in capital-intensive cyclical businesses, it's important that you run rather large cash balances in the rest of your portfolio. So the first thing is right-size your resource portfolio. Focusing on the resource portfolio itself, my own belief is that the easiest near-term gains, the most certain near-term gains, and by near-term, I mean the next 12 to 18 months, remain in the precious metals. I am much more attracted to the precious metals now than I was 3 or 4 months ago during our last interview, where those stocks seemed overheated. Some common sense has returned to valuation, and I continue to believe that government policy with regards to both the economy and the COVID-19 virus are very accommodative for precious metals prices. So I am personally overweight precious metals relative to other extractive industries. But when I say that the easy money, the most certain money, is in precious metals, the big money, looking further out, is almost certainly, from my point of view, in energy. And when I say looking further out, I'm not talking about 10 years. I'm talking about a period of time that might be 3 months, it might be 6 months, might be a year and a half, might be 3 years. The truth is that the most dramatic upside that I see in the resource equities, particularly the junior resource equities, is certainly in uranium for people who can afford to take the risk. What size risk is right? That actually varies from portfolio to portfolio. But I also think that any resource portfolio that isn't beginning to emphasize oil and gas is a portfolio where people make a mistake. So I am not uncomfortable with investors having between 20 and 35% of their investment portfolio in resource and extractive industries. I am not uncomfortable with allocations within the resource portfolio being 50% in precious metals because of the high probability of nearer term success. in precious metals, but it's time to begin to think like a contrarian. It's time to begin to include energy, and included within energy, speculative energy, which is to say uranium, in an intelligently constructed contrarian natural resource portfolio.
If I look at the precious metals space today, there are certain identifiable themes where there is a lot of value for folks that are paying attention to it. If you look at the mid-tiers at 1850, they will be generating a lot of free cash flow. If you look at some of the high-quality developers, the larger producers are running out of reserves, so there's definitely a strong element of mergers and acquisitions ahead of us. And then if you look at greenfield exploration, this has definitely lagged over the last decade. So high-quality teams doing good work in this space could generate speculative returns for investors if they do hit something with a drill. So do you see any clear themes of this kind in the other commodity segments that we've talked about on this call?
Well, you have to differentiate. In terms of incentive price to new production, $1,850 gold is sufficient, which is to say that the gold price doesn't have to go up. I believe it will go up because I believe that gold is one of the few defense mechanisms that private citizens have against the depreciation of their currency by government. But when you juxtapose the valuations in the gold space with the valuation in other commodities, you need to understand that those commodity prices need to go up in order for the supply of those commodities to satisfy demand. When you do a net present value calculation in the gold business, there is no need to put in place an incentive price higher than $1,850 because $1,850 is sufficient to generate new investment. But $30 uranium is not sufficient to generate new investment. So doing a net present value calculation, describing yourself as a value investor, necessitates that you do a net present value consideration at a price that suggests that the economy that we exist in is sustainable. Now, let's back up in the gold space. You're a good student. You've done a good job. There are attractive opportunities. And when I say gold, I should be saying the precious metal space. There are attractive valuations all over the place, but particularly, as you have described, in the mid-tier producers where their enterprise value relative to their free cash flow or their net asset value has substantially lagged the biggest and the best of the companies. This gap either gets closed by value investors like ourselves moving down market and buying relative valuations, or it closes by the companies with a lower cost of capital, which is to say the bigger companies taking over the small companies. But it always closes. The second opportunity, which you have described well, is the development stage companies with economic feasibility stage properties. The truth is that the industry has underinvested now for 15 years, and they have a dearth of development opportunities. And the management teams of these big mining companies are very aware of the fact that they don't address the development opportunities, they'll be out of business in 10 years. Their existing mines will be depleted. So high-quality development assets will be able to attract the capital to be put in production, or they will be taken over. The most dramatic opportunity for people who are willing to take the risks and who are patient is in the exploration side of the business. I would argue with you that the exploration business has been underfunded and misfunded for 30 years, which is to say we have had a 30-year hiatus in real exploration for various precious metals. And the consequence of that is that the shortage of high-quality exploration projects is even more severe than the shortage of development projects. It could be 2 years or 3 years before we have a real exploration market. And by real exploration market, I don't mean a piece of moose pasture in northern Ontario that is half a mile away from a failed drill hole in the last cycle. I'm not talking about mining the market. I'm talking about legitimate exploration to find million-ounce plus deposits that generate 25% return on capital employed at $1,850 gold. So, Aditya, I think that you identified the opportunity very well, which is to say the mid-tier producers, the ones that are cheap on a net asset value basis, not necessarily just on a free cash basis, the feasibility stage developers where they have sufficient scale, that is to say over 1 million ounces in reserve and resource, producible at over 100,000 ounces a year, and generating returns on capital employed, not just returns on equity, not leverage returns on equity, but rather returns on capital employed above 20% or hopefully above 25%. And for those who can afford to take the risk in the exploration side.
This discussion, Rick, would be incomplete if I didn't ask you to look back at 2020. You have personally reviewed over 20,000 portfolios and ranked them over the course of this year. I have personally followed up with several thousand of them, and there were two observations from my end. One was with regards to people's time preferences, and the second was with regards to paying attention to the price that they were paying for a certain company that they were investing in. In your opinion, what have you gleaned from a very statistically significant set of new retail investors that have come our way? What would you recommend they do in 2021, based on your observations?
I think three things. Most investors are still too narrative-driven, which is to say that they're paying much too much attention to online stories and not enough time to management fundamentals or property fundamentals. The second thing you described, which is time preference. The truth is that making money in commodities, either as an investor, which involves investing over a cycle, a 5 or 6 year cycle, or understanding the time frame necessary to answer unanswered questions in speculation, which can be 12 to 18 months. The time frames that are required to be successful as an investor or a speculator in natural resources are unfamiliar to most speculators. Many speculators, because they don't have enough confidence in their actions and they don't do enough work, have trauma holding stock over a long weekend. And those investors either need to exit the sector or they need to wrap their hands around the time frames that are necessary to be a success. Another comment I would have is that most investors and speculators own way too many companies and know way too little about the stocks they own. When I look back at having evaluated 20,000 portfolios this year, a couple things stand out. The first is simply that people are too narrative-oriented. In other words, not enough stock selection has taken place. And the second is, as a consequence of the first, many speculators own 40 or 50 different companies, believing that diversification, in fact, shelters them from risk. Diversification actually increases your risk. The less you know about each individual investment, the greater the probability is that each individual investment fails. I like to say that speculators should limit the number of stocks to the number of hours per month they are willing to spend understanding their portfolio, in conjunction, of course, with their advisor, if they use an advisor.